Welcome to Nexgen Software Services. I'm going to give you a brief overview of our most important indicators and teach you the basics on how to read our software and how to make money with it very quickly. First thing you're going to see indicator-wise, the main components are Fibonacci support and resistance, trigger lines, divergence, and our midbands. And Fibonacci support and resistance is created using thousands of swings of pivots, multiple time frame projections and retracements, and then an algorithm that ranks all of the different time frames, projection numbers, sorts them, and then spits out a simple red or blue line. And it's going to look like this. A red line will end up being resistance and a blue line that's support. Now, some people who have been using Fibonacci in their day-to-day life try to figure out where it came from. And again, it's impossible. It's thousands and thousands and maybe even tens of thousands of swings that cause these red and blue lines. And it's not from a single swing. So when you look at these, again, just keep in mind support and resistance. And more importantly, we're going to show you how to use them based on our trigger lines or moving average looking things that are on the chart. Now, divergence. We're going to go through each of these indicators. We use a MACD oscillator to provide us with divergence. And really, you don't have to know much about it. All you need to know is where the lines are and the numbers on the chart. And then our midband, you're going to hear us say that a lot. It's a 55 period or a 165 period exponential moving average. And just like every moving average can be support and resistance. So again, let's do a visual version of this first. Fibonacci's resistance will be a red line. And if it's from the time frame chart that's showing, it'll have dots in it. You know, we call this a native time frame Fibonacci support or resistance. And again, support's blue, resistance is red. And the reason we use the word native is because we also will plot Fibonacci support and resistance from another chart, meaning a higher time frame or a different time frame than the one that's shown. And you'll see the difference between the two. One of them is smooth and one of them will have dots in it. That's the only difference. Now, when we look at our midband or moving averages, pretty simple. Obviously, when they're going down, it's magenta. When it's going up, it's green. Multiple bars above or below will change the colors. And like every other moving average, it's support or resistance. Now, when we put together multiple supports and resistances, some of them are going to hold and cause the market to reverse, and then some of them are going to break. What we're going to do in this short lesson is we're going to show you exactly how to know what's going to happen next based on what you see right now. Whether, it doesn't really matter whether it's a native time frame fib or a synthetic fib from another time frame. Any of them have the opportunity to hold, and it's the combination of our fibs and trigger lines that's going to show you where the magic is. So let's go through the trigger lines real quick. Trigger line is a moving average looking thing, and we have three of them, or really three different uses for the same trigger line calculation. The smaller trigger lines, or the ones that you're going to see that run really close to the bars, are calculated using 20 bars worth of data. And again, very simple. If the faster of the two averages is above the slower of the two averages, they're what we call crossed up, and they'll be green. And then if the faster moving average is faster and, below the slower moving average, they'll be crossed down and they'll be red. Very simple. You don't really have to know a lot about up or down, red or green. You'll see why in just a second. We have a second trigger line calculation that's exactly the same indicator as the first one. It just uses 1.9 times more bars than the small triggers. So the small triggers use 20 bars, what we call large triggers. I know it's not terribly tricky there. Small triggers, large triggers. 38 bars of data are used to create the larger triggers. It's the same calculation. It's the same indicator. One of them's plot green and red. One of them plot white and cyan. Again, you're going to see how this comes together in a very simple, easy-to-use format. We're also going to plot a small trigger line from a bigger chart on top of a smaller chart. And you'll see this is what we call our synthetic trigger. And the synthetic trigger is kind of the anchor for which we're going to do a lot of trades and a lot of chart reading. So again, it's just, you'll see it's a different look, but it's the same value as a large trigger from another chart. So when we look at our larger chart, we're going to end up with 3 trigger lines on that chart. Small trigger line, a large trigger line, and a synthetic stair-stepping trigger line. And again, this is going to be very important for you because it's the configuration of these 3 trigger lines which will determine one of 3 things. Whether you're going to trend trade, whether you're going to counter trend trade, or whether you're not supposed to trade at all. So think about this. To do a trend trade, meaning with the trend, we want strong trigger lines, small triggers physically above or below the others. We want what's called a transition of a trigger line or a weakening inside trigger line. Now, words mean nothing. Let's look at pictures. This is the picture out of our trading plan. You'll see this used every day in class. If the small triggers are physically below, here, let's do this real quick. I'll turn on a little laser pointer so you can see. If the small triggers are physically below and cutting below all the other triggers, we have a transition. That's transitioning the trend from up to down. And we'll sell a pullback if our Fibonacci's are correct. If we have a number 1 look, which is, look, small trigger down below the large trigger, below the synthetic trigger. All 3 down and the smalls are below, that's our number 1 look. What you're going to see happen later in the trend is these small triggers will physically get inside of the other triggers. And this is what we call weakening. And this weakening look is when we normally will get counter trend trades that go long from Fibonacci support. And then you'll see the same thing in reverse. We have a number 1 look going up, and then we have an inside look going up. And again, you'll see how this all comes together in our trading rules. So to give you a bigger picture of a chart, if the market is trending up, we want to go long on a pullback, right? Buy the dips. If the triggers are weakening, right? And again, weakening is when the triggers are inside of the other triggers. So if we're at Fibonacci resistance and the triggers are weakening, we're going to go short from the top, hopefully, right? Now, if the small triggers transition below the other triggers, we're going to sell a pullback with the new trend to the downside. And again, this is where we're going to go start looking at our other charts to know exactly where to get in. And then if the market's trending, it will usually continue until we get the triggers to weaken and get inside of each other. And if we just so happen to be at Fibonacci support, we will do a counter trend trade to go the other way. Now, one more look that we have is when these small triggers are physically between the synthetic and the large triggers. And we call this look a range-bound look. No trend trades in a range-bound look, but we will do edge trades or counter trend trades. So look, this is the most important thing that you're going to go through. The correct versus incorrect Fibonacci and trigger line look. With the correct Fibonacci and trigger line look, you're going to attack the markets with confidence. You're only going to do high probability trades, and every one of your trades will have the same look, giving you the ability to be consistent and confident, knowing that you're doing the right trades. If you do a trade and the trigger lines and fibs are not read correctly, number 1, you're probably going to lose, and number 2, you will have no way to be consistent. Now, this is what our classroom is for during the day, to teach you as it's happening the correct looks and to double check your work to make sure that you're trading with the correct look. So the look of the fibs and the triggers will be important for you because you'll know whether you should do a trend trade or an edge / counter trend trade. So again, let's look at one example. If the market was making a trigger line transition on our larger chart, this is where we start our trend trades. And again, transition is nothing more than our small triggers getting below the others. During the pullback, we're going to look for a short. You see what happens. Now, the same thing over here. We have a transition to the upside. Small triggers are up and they're above the other triggers. If we get a pullback, we're going to want to do a long trade if the Fibonacci's are correct. So let's take a look at the correct look for Fibonacci. If you have a transition in your triggers and you have Fibonacci support and have not yet reached Fibonacci resistance, then you will buy a pullback into support using your larger and smaller charts to help you out. So this is a correct look of a correct trade with the correct Fibonacci and trigger line reading outcome with the transition. Unfortunately, this is the real world. In the real world, we had a Fibonacci resistance here, and we only had 2 of our trigger lines. We need 4 passed to trade through a red line. So because we had a red Fibonacci resistance, this is the improper transition look. This is a look, this is the same trade. Take a look. And again, I drew these fibs on to kind of cheat, but you can really see the difference. Fibonacci support that supports the trigger line transition, room to the next target, everything's okay. Fibonacci resistance with a transition is going to hurt this trade and you're not going to win it. And again, the trade is incorrect due to Fibonacci and trigger line reading. So when you're looking at your chart, you can't just look at the trigger lines. You have to look at the transition. You have to, during the pullback, look at the Fibonacci areas here and here to make sure it's right. Now, again, when you end up with a wrong look, right, and you don't have a high probability trend trade, if you practice the wrong trades and continue to lose, number one, you're not going to reach your financial objectives. And number two, it's going to lead to frustration and it's going to lead to losses. And again, this is where it's imperative in the very beginning that you post in your trades into our classroom, so we can make sure that you're not reading the trigger lines wrong so you can do the right trades so you can make a bunch of money. Again, correct Fibonacci and trigger line reading will lead you to do the right trade, the same look over and over and over. Let's look at some examples. So this is our normal configuration. We have a 14-2 chart, an 8-2 chart, and a 5-1 chart. Now you may be saying to yourself, what does that mean? Well, the charts are, the bar structure on each of these charts is identical. And each chart is built on range or number of ticks. So the bodies of these bars are all 14 ticks. The bodies of these bars are all 8 ticks range. And the bodies of these bars are all 5 ticks range. So this is a faster chart, this is a medium chart, and this is a slower chart. Essentially, it's the same data, it's just being displayed differently. So obviously, you don't have to use 14.2. If you're using stocks or NASDAQs or, Dow Jones or a more volatile market, this chart will end up being larger than a 14.2. Our large chart, again, think about it. 3 triggers. Small triggers, large triggers, synthetic triggers. And the configuration of these 3 triggers is going to determine whether you're going to take a trade or not. When you look at your 3 charts, and again, we're looking for synergy, simplicity, easy. The synthetic trigger on the 14.2 chart is also the same synthetic trigger on the 8.2 chart, and it's also the same synthetic trigger on the 5.1 chart. They all plot the same 24/6 synthetic trigger. And we use the synthetic trigger a lot, obviously, with our reads of our Fibonacci and trigger lines. Now, on the 8.2 chart and the 5.1 chart, the red and blue Fibonacci's, they're the same. So the same blue fibs are the same blue fibs, and the same red fibs are the same red fibs. Synergy between the two charts is very, very important so you're not confused as to when to get into a trade. Also, the Fibonacci support and resistance that's on the 14-2 chart will also be superimposed on the 8-2 and the 5-1 chart. We didn't go backwards. We don't plot the 5-1 on the 14-2, but you're going to be staring at your 5-1 chart a lot. So you don't really need it. Again, consistency, consistency, consistency. That's what we're looking for across the charts. Now, our rules, which you will learn very intimately and very quickly and very easily. Number one, make sure that the 14-2 chart or larger chart has the correct one of three looks for transitioning, strong triggers, or inside and weakening triggers. Number two, make sure you haven't run into trouble, fib resistance or divergence or trigger line trouble. Number three, buy or sell a pullback into Fibonacci areas and triggers when the background color is correct. It's gonna all be red when you're going short, or it's all gonna be green when you're going long. So it's really very simple. And we're gonna have an oscillator that will help you with an overbought or oversold condition. Always try to enter, and again, it's not always possible, but when possible, when the trigger lines and the Fibonacci's are together helping each other, you're going to see much more synergy in the market. Let's take a peek real quick. Page 2 of the trading plan. This is our trend trades, okay? And again, it's just what we just covered. Number one, you have to have one of the three looks, strong, transition, or weakening look on the 14-2 chart or larger chart. B, make sure that you don't have one of these conditions, fibs or divergence or the wrong trigger lines, that could terminate or lower the probability of your trend trade winning. And then when you have synergy between your 8-2 and your 5-1 chart, you're going to really have a higher probability trade. When you don't have synergy between your 5-1 and 8-2 chart, not that you won't get a trade, but it won't be the highest probability trade. Every day you're going to see the same thing. There is maybe 3 days a year where you're not going to see tons of trades that pop up. Edge trades or trend trades, counter trend or trend trades. You're going to get 4 to 10 trades a day. Pretty much every day. Some days 15 or 20 trades. So there's a lot of opportunity to make hundreds, if not thousands of dollars per day. So again, every great trade that you do will have synergy. You will have the correct look on your 14-2 chart triggers. You will have triggers below on your 8-2 chart. You will have large triggers helping the Fibonacci area on your 8-2 chart, which you also have the same large trigger from the 8-2 chart superimposed on your 5-1 chart. So this large trigger is the same as this trigger. This fib is the same as that fib. So when you get this look, this trigger, and these fibs, you're going to be going short right there. And you're going to be getting out when it gets down to support. And if you don't have this synergy, you just don't do a trade. You just sit and wait for it, and it will line up every single day, day in and day out. You will see this is again, just a 5-1 chart, but every single trade that you do will look the same. You're going to be able to place a limit order at fibs and mid bands and triggers that you'll be going short when the market's going up and then getting paid when the market goes down. And again, you're going to have losing trades. The idea is to build this synergy between all charts so everything points to one area. And it's absolutely the right look on all three charts. Again, this is a 5-1 chart. And again, it's the same thing. We do this 1,000 times a week. Trend trades, 14-2 chart triggers are correct. Make sure you haven't hit a bad spot. Buy a pullback to your triggers, mid bands and fibs, mid bands and triggers, Get out when you reach the next Fibonacci resistance. You're going to see the same trade over and over and over. So let's take this a little further. I want you to see, look, when the small triggers are above or below the larger triggers, Fibonacci resistance, you see where my pointer is right here? It's going to break almost every time. When you get Fibonacci resistance and the triggers are inside of each other, weakening, Fibonacci resistance will hold, and you will be able to do a counter trend trade. When you get to Fibonacci support and the small triggers are below all of the other triggers, it will break and you will do a short trade on a pullback. When you get to Fib support and then the small triggers are finally inside of the large triggers, you will then get a counter trend trade that will have a high chance of winning. Very visual, very simple. Let's go through it a little bit more in detail. Number one, strong look, small triggers above the large triggers, above the synthetic triggers. Very, very simple, very easy to see. When does the market turn? Well, the market turns when the small triggers physically get inside of the large triggers. So what I did here, look, I superimposed, these are real fibs from a real day. So when we get to fib resistance with this trigger line configuration, which you'll never even have to guess, you'll never even have to hear this again if you just believe it the first time. Strong triggers are going to break the fibs. You will buy a pullback on your smaller chart, and you will make it up to the next Fibonacci resistance most of the time. When the resistance is hit and the triggers are weak and inside, you will go short and you will make money more often than not. So again, it's very simple. You can trend trade when it looks like this. You can edge trade or go counter trend trade short when it looks like that. Let's do some more trigger line reading and work, and you'll see how simple this is. Perfect example of a transition trigger. Look at your triggers getting below the synthetic triggers. Nice and easy. You're going to go short, right? Well, not so fast. If you hit Fibonacci support during a transition, you won't go short. It's in our rules on page number 2 on the trading plan, but again, it will be easy for you to understand this when you've seen it 1,000 times. You will go trend trade long when they're going up. You'll go counter trend trade at the edges, and you won't get tricked into a short trade because your Fibonacci will save you. Let's go a little further. Strong trending down triggers, you will sell a pullback, you will sell a pullback, and then triggers get inside of each other. Again, when the triggers, small triggers get inside, we're going to check for Fibonacci support. If we have Fibonacci support, we will stop doing short trades, and we will then look for the rules for a long trade to be initiated if we get our rules to be met, which we'll go over in just a second. Again, if these small triggers are between the large and synthetic, we have what's called a range-bound look. Typically, we do not trend trade in a range-bound look, but we can do counter trend trades from the edges. So if you have Fibonacci resistance at the edge in a range-bound trigger line look, you can go short. When and if the small triggers get above all of the other triggers, the range-bound look will be over. You will never again have to guess if the market's going to be choppy. The trigger lines and fibs will tell you with ridiculous accuracy when that's going to happen. When you get a number one strong trigger line look, you will absolutely 100% of the time take a trend trade short on a pullback. And you will continue to do so until the triggers get bunched up and tight and you've hit Fibonacci support. Now, I want you to think about something for a second. When they're wide, you're going to have the confidence to do a short trade. When the blue fib turns red, even though we've weakened the triggers a little bit, if we were at a blue support, you would stop going short. Because we have not yet reached the blue support, you will do another short trade. So you'll do a short trade here, which will be worth $200. You'll do a short trade here, which would be worth at least $200. And then ultimately, when you reach the last Fibonacci support and all of your trigger lines are bunched together, you're going to be on guard for the market to put in a reversal. Again, small triggers strong below all the others. After a failed transition up, it looks like. See how the synthetic triggers never crossed up? You will do a short trade 100% of the time, guaranteed, and you will be confident doing it. When and if the triggers come together, if you have Fibonacci support, you will stop doing short trades. You will be able to clearly, easy, and accurately see when you will do a short trade, when you reach a target, and again, we probably would do a counter trend trade down here. And again, our counter trend trades are one and done. Because if we don't win this, or if we win a little and then it doesn't follow through, once the trigger lines physically break support, we're going to wait for the support to turn red or the trigger lines to transition back up. Absolutes, that's what we trade in, guys. Now, the second or final piece that I was going to bring to you is the divergence between price and our MACD indicator. Again, we used the MACD indicator 15, 20 years ago. We don't really use it anymore, but it still plots divergence for us. And the short version is it measures a retracement percentage between price and the oscillator. If the price is not congruent with the oscillator, we say there's divergence. If there's divergence, it'll plot a negative number on the pivot, so you don't even have to guess. It'll do it all for you. And then it'll draw a line. These are the entry points for our counter trend trades. So check this out. If you start up here and you go down to here with price and you make a retracement, which is a 786 retracement, 78%. If the oscillator goes from here to here and only makes a 50% retracement, guess what? You have divergence. If you have divergence, it will plot this negative 32% or whatever the percentage is. And it will also draw this magenta line going out to the side. So again, this is just mechanics, nothing to really know here. So if you have a negative number with a line, you have divergence, or if you have a negative number on the bottom with a cyan line, you have divergence. The magenta line or the cyan line are the place where you will place your limit order for a long or short trade, or within a few ticks of that usually. If there's a fib just past it, maybe it's a fib. So let's talk about rules. Counter trend trades. Price must be at support or resistance. The large chart must not have a strong trigger line look. Divergence must be true, and you place the limit order at the magenta or cyan line. So watch. This is it. Every time, same thing. You get to Fibonacci resistance. Obviously, the large chart has to say it's okay. You're going to get a negative divergence, which is going to create the magenta line. You will place a limit order at the purple line, magenta line. When the market goes up to it, you will get filled. If Fibonacci resistance holds like it's supposed to, you will make a lot of money. If it doesn't, you will lose a little money. The idea of placing the limit order at the magenta line is so that you're actually selling the top. And if it works and puts in a down bar, you'll be risking very, very little. If it doesn't, it's one and done on counter trend trades. And then ultimately, as the market trades down and you get to support, the only way you'll do a counter trend trade is the same way. You will have a negative divergence. You will place a limit order at your fibs and your cyan line right there, and you will go long from this spot right there. That's it. So let's back this up one more time. When you look at your small triggers, if they're physically above, resistance will break. If they're inside, resistance will hold. Do a counter trend trade. Do a trend trade here. Do a counter trend trade here. You get to support, triggers are below, you do a trend trade short. You get to support, triggers are inside, you can do a counter trend trade. Look at the red X over here on the left. You get to Fibonacci resistance, but the triggers say we'll go higher. the market actually does go higher and gets to the next resistance. When you reach the next resistance, the small triggers are inside of the other triggers, which means you can now use the divergence at the resistance, place a limit order at the magenta line, and go short and make a bunch of money. The bonus is when this trade works, pivot stop out at the edge of fibs, we call it, because they kind of stop out the high. But you're getting filled on the way up at the limit, a limit to sell at the magenta line. It's a beautiful thing. When it doesn't work, you get run over, but when it works, it's really beautiful. So make a lot, lose a little. Sell high, buy low. Now, if this one works, you almost always get a second bonus trade, which is at Fibonacci resistance when it changes colors, and then you can get the second one. So you can get short, you can make up some money, and then you sell a bounce, and then you make more money. Almost every time. So when you're done with your day, every day it's going to look like this. You're going to do a pivot stop out at the edge, and you're going to go long, and you're going to make some money. And then you're going to get short at a pivot stop out at the edge, and then you're going to say, oh, wait, it wasn't quite the edge. Let me get out because that's a trend trade long. Now I've got the right Fibonacci edge, and you're going to go short, and you're going to make some money. And then when it changes colors, like I told you, you're going to sell a pullback to your triggers and fibs, and you're going to make more money. And then when it gets to Fibonacci support, you're going to place a limit order at the bottom. No trade. But if it starts trending up, you will buy pullbacks, and you will do trend trades. There's only two trades, guys. Pivot stop out at the divergence, at the fibs, or trend trades. With the triggers, with the fibs, with the correct color, that's it. Only two trades. So here's how you're going to get better and you're going to make money with our software, and you're going to do it consistently. Learn the correct trigger line and Fibonacci rules for when you can trade long or short trend trades and when you can trade from the edges. Simulate your trades on a daily basis during the day, live. Right? To be a better trader, you have to trade. Don't be a professional video watcher, be a trader. Simulate your trades. Post your pictures in the class. This is one that's a little scary because you're going to post in losers, but that's when you're going to learn how to correct very quickly the wrong Fibonacci and trigger line read. Simplify these two trades in your plan and your brain for yourself. What's the trigger line looks where you'll do a trend trade for sure? What are the trigger line looks where you'll do a counter trend trade for sure? Without what looks are you going to commit to? After the class in the morning or the trading is over, NinjaTrader has the ability to download the day's data, replay the day, and retrade the day. And what you really need to do is go back and retrade and fix any mistakes that you made, or take the trades that you missed or you skipped, because you need to have consistency in the trigger line look and the trade that you do and the way that you manage your trade, and the trigger line look and the fibs, and everything you do has to look the same day in and day out. Take a picture of the correct trades. Repeat this process every day. Trade during the morning. Go back and retrade and fix it in the afternoon. Do it every single day until you can personally guarantee yourself that you can win, you can trade the rules, and you're going to be able to trade live money. When you get to live money, if you don't have $3,000 to put into a trading account, you now have the beauty micro ES or Dow Jones or the NASDAQ, but the micro ES you can trade with $50 in your account. So you could technically open an account with $300 and you could build up to the $3,000 to trade the big contracts. Either way, whether you start with $3,000 and you trade a big contract, or you start with the micro ES and work your way up to crude oil and the S&P, and you can trade both markets if you wish, get a couple extra monitors. If you trade one contract with $3,000 and you do these trades and you do them consistently, you're going to make more than $400 a day most of the time. Now, Nothing's guaranteed, of course, but consistency in the markets usually wins. Inconsistency usually loses. That's why every day it's imperative that you do the same thing with the same look, the same way every day. We've done this for 22 years. We know you can make this much money. You have to be able to put into practice the right look. Again, if you make $400 a day, you're going to average 8 grand on one contract. So you might spend a month or two on simulator and then you trade live. And if you spend just 3 months trading one contract, which is not a lot, and you actually make $24,000, then you can start ramping up your number of contracts. If and when you get to 8 contracts and you make 400 a day, you're looking at $64,000 a month. Nobody would be unhappy with that. Again, consistency is the key. You can start with as little as $300 on a micro ES. When you get to 3,000, you can move up to the big contracts. Now, longer versions of what we just went through. Should be pretty obvious what you need to do at this point. Strong trigger lines, you're doing trend trades. Weak trigger lines, you're doing counter trend trades. These are longer videos that go a little more into depth, but it's the same concept. There's nothing new. We've done this forever. You're going to only learn these two trades. Trade from the edges with the right fib and trigger line look. Do trend trades with the right fib and trigger line look when the charts are consistent. How to study and do market replay is in a video. And then ultimately, how are you going to manage the trade once you're in it? Watch those longer videos, and obviously there's a lot of video information that we have, but you've just learned everything you ever need to know. You just need to practice it. On our YouTube page, if you subscribe, you'll get new videos. We've got thousands of videos. And again, it's the same thing over and over and over a million times. Trend trades, counter trend trades, how many times can you do them? And then ultimately, our live class, 9 to noon Eastern time every day. We watch the live market. We'll put trades on. We'll look at your trades. We'll do trades together. We'll talk about the fibs. We'll talk about the triggers. We will make sure that you're going to get perfect trades. So it's the navigation through the triggers and the fibs and making sure that you have everything that you need in order to be successful. I really look forward to teaching you guys how to make money with fibs. More importantly, I really look forward to teaching you guys how to get off of the simulator and to be able to guarantee yourself you can make money. And not just money, I'm talking about a lot of money. Start with a teeny tiny amount. Give me some time in class and let's go through the consistent looks together. And we are going to help you achieve your objectives. I appreciate your time and I look forward to seeing everybody in class.